G'day everyone and welcome to another episode of FinChats. Throughout 2023, we've seen a remarkable rise in equity markets. The S&P 500 has risen 19% year to date, whilst the Nasdaq 100 has really ripped through this year by 47%, led by the AI thematic and those magnificent 7 stocks. In the bond markets, the 10-year yield has risen sharply from the beginning of the year to around 4.4% today. It's nearly reached a high of 5% back in October. And compared to the 2-year yield at around 4.9%, this is an inversion of the yield curve of about 50 basis points. And this has been going on for quite some time since last year. And so naturally, this is causing a lot of volatility in both the equity and bond markets. And, we really wanted to talk about today about the asset allocation frameworks to position portfolios for 2024. And so, firstly, the first discussion point is whether we have a soft landing or not, which is essentially where a central bank will meet both its dual mandate targets of consistent of full unemployment, and also of an inflation target between 2 to 3%. Now, inflation is still very high, but it is coming down in most developed economies. There is a disinflationary trend. However, on that front, I do see inflation to be quite sticky, particularly in Australia, where you have high immigration levels really pushing up rent prices. And you're seeing a similar thematic in the US as well, where rents and owner equivalent rents are really holding up that CPI number. I think there are also more structural inflationary factors which will really hold up that level, not to the 2% range, but more in the 3 to 4% range. Things like onshoring, global production lines, and whatnot. And so when I think about the employment side as well, monetary policy tightening throughout 2022 is still feeding into 2023 and onwards. We're starting to see pockets of consumers being affected disproportionately, those with lower assets and lower levels of savings, because each marginal dollar is squeezed, so they can't really spend on things outside of consumer staples and groceries. I think that what we've also seen in the past is that when central banks have tightened quite significantly, this has tended to result in recessionary outcomes. Now, past events aren't, going to guarantee what's going to happen in the future, but it is a good guideline as to how central bank think and the psychology behind certain decision-making policies. And so, on the margin, I think that a soft landing scenario is, mild. I think there is a 50-50 chance. And I say that because my thesis and my thinking might be, challenged if the consumer is more resilient than I thought. There was a significant amount of pent-up savings that was accumulated during COVID and the 2020 era, when governments had super low interest rates throughout that period to really incur savings. And so, in that backdrop, a soft landing scenario is roughly 50-50, if not a bit more. In terms of equities, I think that they remain challenged, particularly in the US, just from a valuation perspective. So if we look at the valuation on the S&P 500, it last closed at around 45-50. Forward 4-quarter operating earnings were at around 239. That's around a 19 times forward multiple, which is equivalent to a 5.3% yield on the equity market. Now, when you compare that to the 10-year yield of around 4.4%, that's only a 90 basis point equity risk premium, which compared to the historical long run average of around 4 to 5%, you're definitely not being compensated the same amount for taking equity market risk. When you can just be in fixed income, locking in that 4 to 5% yield risk free. So I think that equities remain challenged, particularly in the US, as I said, also in the Eurozone and UK as well, where economic growth story is being challenged quite significantly there. Japanese equities look quite interesting with shareholder reforms. The government allowing companies to buy back shares and really letting inflation run through the economy again. And so foreign investors are looking at Japan as an attractive equity market to invest their capital. The yen seems to be appreciating as well, as opposed to the US dollar, which is sort of depreciating away, which allows for a pretty profitable carry trade if you look at that, through that currency lens. And in terms of fixed income, I think it's actually a very attractive asset class at the moment, given that the consensus is that yields have peaked, and you typically want to be in this asset class when that scenario does happen, because the only other way for rates to go is back down. And when you're long duration, that dip in rates will really add to your capital gains. In the US, fixed income is quite attractive, particularly on the short end. If we do ever have a recessionary outcome of some sort, short rates will be the first to drop. So I'd be positioning for short to medium term duration in the US. I think long term duration, you're taking a lot of interest rate risk, and what we've seen so far is that yields in the 10-year have been super volatile through this year, nearly hitting 5% in October. It rallied quite hard on the Israel-Hamas war conflict announcement in early October, and it's sort of gone back down. You can also look at the MOVE index as well as a proxy for bond volatility. It's significantly higher than the VIX, which is a proxy for the equity market index. So, all in all, short to medium term duration in the US looks attractive. I think that more genuinely high quality credit is also good. Good corporates with healthy balance sheets and high returns on capital are good places to look. And in terms of sectors, I think that a lot of sectors are challenged clearly right now, but we're really looking at sectors that have secular tailwinds. Semiconductors is one, and also clean energy too. You're seeing that they're not really impacted by the inflationary story. There are a lot of tax credits, for example, that the US government is providing for the clean energy sector. And so that really allows them to generate profits and not really have to worry about their cost structures too much. And everyone knows about the semiconductor story and the huge tailwinds there are behind it, with different chips being made for AI capabilities. And so those are some interesting sectors to look at. Naturally, the consumer discretionary sectors are challenged with those rising interest rates biting into consumer spending wallet. But all in all, I think that the overall equity market, as of now, is offering a lot of great opportunities for active stock pickers. You're seeing a bifurcation in the equity markets, with the Magnificent Seven stocks obviously rallying that large cap aspect of the market. But if you look towards the mid and small cap end of the market, they're not really generating the same amount of returns or expectations that the market would think it would, in the same way that the large caps are. So if you really look within that segment and do your due diligence and see which companies are really, healthy in terms of their balance sheet, they don't have too much debt, they're really generating high quality returns on equity, and they really have a good industry backdrop for them to increase profits quite sustainably over the medium term. If you can find those businesses, both on the equity side and the debt side, then you might find some good allocation opportunities. So